Hi, it's the Tax Geek with more of your taxes oversimplified. In the last episode of IRA 101, we looked into IRA contributions. If you haven't seen the first episode of IRA 101, you might want to click on the card above or the link in the description. In this episode, we're going to take a look at distributions from traditional IRAs. We'll cover distributions from Roth IRAs in an upcoming episode. When you withdraw money from any IRA, you receive a 1099-R form that should look pretty much like this. If you're unfamiliar with 1099-R forms, here's a card linking to a video that explains them. On all 1099-R forms for IRA distributions, there's a checkbox indicating the taxable amount is not determined. This is because the payer never knows if there's a basis in the account. We'll look at what basis is later. The IRA/SEP/simple box should also be checked. The amount in box 2A might be blank, or it might equal the amount in box 1. Since many people have confused a blank box 2A with a taxable amount of 0, to be on the safe side, many payers put the full amount of the distribution in box 2A. But that doesn't necessarily mean the entire amount is taxable. Let's take a look at several people who have received different types of IRA distributions. I'll show you how the distribution is reported on the tax return, and I'll also show you how the taxable amount and any penalty taxes are calculated. To start off, let's meet Tom. Tom withdrew $25,000 from his IRA. Tom is age 65 and has never made any non-deductible contributions to his IRA. Notice that the distribution code on his 1099-R is 7, which indicates a normal distribution. In this case, the entire amount of the distribution is taxable and reported directly on line 4B of Form 1040. Next, we have Tom's brother Richard. He has also made a $25,000 withdrawal from his IRA, but Richard is only 53. However, like Thomas, he has never made any non-deductible contributions to his IRA. On Richard's 1099-R, the distribution code is 1, indicating an early distribution. This distribution is subject to a 10% penalty tax on the amount withdrawn, unless an exception to the penalty applies. The various exceptions to the 10% early withdrawal penalty will be discussed in another video. Assuming no exceptions to the penalty apply, the entire amount is taxable and entered on line 4B of Form 1040. The penalty is entered on line 6 of Schedule 2, which is then carried to line 17 on page 2 of Form 1040. If the distribution code on the 1099-R is 2, 3, 4, or 7, the distribution is not subject to a 10% penalty and is treated just like Tom's. Now let's meet Harold, age 68. Harold withdraws the entire $250,000 from his IRA. However, many years ago, Harold made a non-deductible contribution to his IRA of $5,000. Here, you'll notice that the total distribution box is checked on Harold's 1099-R. To determine the taxable amount of the distribution, the $5,000 non-deductible contribution, which is called the basis, needs to be subtracted from the total distribution. Otherwise, Harold would be paying tax on the $5,000 twice. This yields a taxable amount of $245,000. The total amount of the distribution is reported on line 4A of 1040, and the taxable amount of $245,000 is reported on line 4B. If the total distribution box on the 1099-R is not checked, and there's a basis in the IRA, things get more complicated. The taxable amount of the distribution is calculated as follows. Step 1. Add the distribution to the fair market value of all the IRAs you own as of the end of the year. Step 2. Divide the total non-deductible contributions you made, or the basis, by the result from Step 1. This will result in a fraction. Step 3. Multiply this fraction by the whole distribution to arrive at the non-taxable portion of the distribution. Step 4. Subtract the non-taxable portion of the distribution from the whole distribution to arrive at the taxable portion of the distribution. And lastly, subtract the non-taxable portion of the distribution from the original basis to arrive at the basis for any future distributions. Let's look at Elizabeth, age 62. She withdrew $25,000 from her IRA and, like Harold, she made a $5,000 non-deductible contribution to her IRA. Since this is not a total distribution, she will need to know the fair market value of her IRA as of the end of the year. The fair market value of her IRA is reported to Elizabeth on a 5498 form her IRA administrator sent her. If she had multiple IRAs, she would have to add up the fair market values of all the IRAs she owns. First, she adds the distribution to the fair market value, resulting in $250,000. She then divides the $5,000 basis by the $250,000, resulting in 0.02. She then multiplies her whole distribution by this fraction to get the non-taxable portion of her distribution, which is $500, and the taxable portion of her distribution of $24,500. On Elizabeth's 1040, $25,000 is reported on line 4A and $24,500 on line 4B. For any future distributions, her basis is then reduced by the $500 non-taxable portion of the distribution to $4,500. Both Harold and Elizabeth also report their distributions on Part 1 of Form 8606, non-deductible IRAs. Here is Harold's 8606, and here is Elizabeth's. This form shows the step-by-step process described earlier. And that is how distributions from a traditional IRA are reported on a tax return. Of course, there are always additional details which can be found by clicking on any of the resources listed in the description below. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. If you have any questions, comments, or suggestions for future videos, please leave them in the comment space below. Thanks for watching, and stay tuned for more of your taxes oversimplified.